Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Stocks sank at the open as oil's rapid surge intensify war fears. Wall Street is bracing for a prolonged and deeper fallout from the Iran war as oil tops $100 a barrel. Things were pretty grim at the open, but in the first hour, the markets have fought back. U.S. S&P 500 sits down 0.5%, down 31 points to 6708. The Dow Jones Industrial Average sits down 361, down 0.75%. It was down 700 at one point. The Nasdaq down almost fractions, down 0.1%, down 25 points to 22,362. The Russell 2000 down 1.1%, down 30 points to 2495. The VIX is what a lot of people are watching right now. It sits at a reading of about 28. Earlier in the morning, it spiked as high as 35. Any number over 27 is typically considered fear. And be greedy when others are fearful is one of Warren Buffett's best lines. And this is a gauge of fear. So opened at 35, that's pretty high. 40 is usually a buying level on Wall Street. Opened at 35, is pulled back to down a 0.50 to just 28. Still a pretty high level of fear. Bitcoin's rallying today, up $1,920 to $69,087. 10-year Treasury sits at 4.14%. Gold not doing much, down 65, down 1.2% to 5,093. The silver index is up fractionally, but it's the commodity that we are circling today is crude. Sits at $97.54 a barrel. Brent crude sits at $99.43, just under 100. Interesting how big round numbers play out, huh? It was only about a week ago when we saw the big news on the war. And then by the end of the week, we saw awful jobs numbers come out of the Trump administration. More on that in a couple minutes. In between panic spread, last week we got fear on credit markets. The government's tussling with one of the country's top trade courts over tariff refunds. There's a lot of jolts in the economy last week. A lot of jolts to the market. A little bit of war, bad jobs numbers. What are we going to do now that tariffs have been ruled illegal with the money that we collected? How is it going to be collected? Gas prices are ratcheting higher. This week, what do we have to look forward to? Maybe some de-escalation and tensions in the Middle East. Well, Iran is signaling anything but that at this point in time. February's Consumer Price Index will be released on Wednesday. The CPI, followed by the PCE on Friday. That's the personal consumption expenditures. The Federal Reserve will be eyeing both those metrics as it faces an interest rate decision next week. Inflation data is key right now. The central bank's getting mixed signals from the labor market so far this year, while jobs in January report came in hotter than analysts expected. February made them shiver. Let's talk real quickly about those jobs numbers. Unemployment hit 4.4%, a slight tick up. But you remember maybe last year at this time we were talking about the Trump boom. The U.S. economy unexpectedly lost 92,000 jobs in February. Trump has been in the White House for 14 months, and during that time, the cumulative total is 150,000 jobs. In the last 14 months of Joe Biden's presidency, by contrast, the American economy added 1.74 million. I do have an event coming up Wednesday night, about 48 hours from now. Should be a good event. Timely, I would say. A lot to talk about. It's a wealth preservation retirement planning event in Lafayette, California. You can sign up for it at robblackshow.com. It's 6:30 to 8:30 on Wednesday. Oracle is going to release their earnings report tomorrow after the bell. The tech giant recently became part owner of TikTok. Last week it was reported via Bloomberg that Oracle plans to lay off thousands of employees as it tries to make good on its big data center bet. The price has been crazy on Oracle recently. It doubled and then got cut in half over the last year. And the Oscar goes to... That's coming up on Sunday. One of the movies that's going to be nominated, probably the only nominated one that I've seen, is Sinners. It has the best shot at collecting the most hardware with a record 16 nominations. Conan O'Brien's going to return to host the ceremony after pulling in strong ratings last year. Big story this morning is stagflation and odds of recession. Stocks are facing growing risk of a sharp sell-off this year as the escalating war in Iran hurts global markets. Veteran strategist Ed Yardeni, he's the man on the floor of the NYSE. He's saying odds of a market meltdown are up to 35% for the rest of the year, up from 20%. He slashed the odds of a melt up, which is a rally driven more by investor enthusiasm than underlying fundamentals, just 5% from 20%. The shift in those weightings comes as oil prices surge above $100 a barrel and investors brace for prolonged conflict. The U.S. economy and stock market are stuck between Iran and a hard place currently. So is the Fed, Yardeni wrote in his blog. If the oil shock persists, the Fed's dual mandate would be stuck between the increasing risk of higher inflation and rising unemployment. Stagflation. The dollar has emerged as the haven asset of choice for now. The resilience can be partially attributed to the fact that the U.S. has greater energy self-sufficiency than other markets such as Asia. Concerns over artificial intelligence spending and potential business disruption had already been taken some of the sale out of U.S. equities in February. Investors have pushed back expectations that the Fed's next quarter point cut rate is going to happen now into September. Traders had fully priced in the expectations of a rate cut for July. Some option traders are now betting the Fed may not cut rates at all this year. Trump said Sunday night the military campaign against Iran was worth any near-term pain because it would deliver lasting benefits, calling $100 oil a small price to pay. Iran's decision to name Mojtaba Khamenei, the hardline son of the assassinated Ayatollah Ali Khamenei, as its new supreme leader, signals that Tehran's not going to back down in a war that's now raging across the Middle East. Yardeni has gotten a lot of market calls right in the past. In December, the strategist recommended effectively going underweight the so-called Magnificent Seven versus the rest of the S&P 500. His base case remains intact, the so-called Roaring 2020s. That envisions a decade of robust and sustainable U.S. growth fueled by rapid productivity gains that still carries a 60% probability through the end of the year. The outlook is better over the coming decade. Yardeni assigns an 85% chance of continuation of the Roaring 2020s. He also sees a 15% chance of stagflating 1970s style. 15%. So rising oil prices are existential threats to airlines as oil prices surged. Amidst the war in Iran, airlines are facing a jet fuel margin squeeze not seen since the aftermaths of Hurricane Katrina and Rita back in 2005. Airlines are going to be forced to ground thousands of aircraft that are less fuel efficient. The more financially vulnerable carriers could even be forced to suspend operations on flights. Immediately this week, you're going to start seeing jet fuel prices surging. Last week, they were up 58% in a single week, jumping from $2.50 a gallon in February to $3.95. The big four airlines, United, American, Delta, and Southwest, face $5.8 billion in additional fuel costs. Ticket prices will rise between $10 to $20 per domestic flight in the near term. Some analysts see a surge of up to 20% by May 2026. Fuel typically accounts for about 20 to 30% of an airline's operating costs or inputs. Basic economy may see smaller hikes to avoid scaring off price-sensitive passengers. So premium economy. It's a funny two words to put together. They don't exactly go together. It's either premium or it's economy. But airlines call it premium economy. And first class fares often see much steeper immediate increases. Gasoline prices are going vertical too. Highest level in nearly 2 years. U.S. drivers are facing roughly about $187 million extra per day compared with last weekend. Average for regular gasoline has jumped 17% to $3.48. Expected to climb to $3.75 to $3.95 this week. California leads the nation at approximately $5.20 per gallon. Some areas of California are bound to hit $6 to $7 a gallon. Oklahoma, Mississippi, and Kansas still have the cheapest gas in the nation at $2.90. It's unknown how long these price hikes are going to last or how high prices will climb. It depends on how long oil supplies remain disrupted. So no end in sight to the Iran war. Oil is surging. G7 officials are discussing tapping their strategic oil reserves. Oh, I should mention that crude last night hit $119, but it did pull back to $100. An attack on a water desalination plant in Bahrain. Israel's attacks on fuel depots in Iran. The Strait of Hormuz is effectively closed. Kuwait, United Arab Emirates, Iraq, and now Saudi Arabia are curtailing production because there's nowhere to put the oil. So Oracle's going to have a big report tomorrow night after the market closes. One analyst today lowered his price target on Oracle to $300 from $375. It's currently a $153 stock. There's a lot of drama going on with Hims and Hers and Novo Nordisk. Now Novo Nordisk is planning to sell blockbuster obesity drug Wegovy on telehealth platform Hims and Hers. Hims and Hers was controversial because they did a copycat GLP-1s. Their stock is up 50% today. Novo Nordisk is looking for ways to catch Eli Lilly. It's an odd deal. One analyst at Wells Fargo has downgraded Netflix to hold from buy. He's worried about decelerating revenue growth and higher content investments. To me, the stock looks pretty cheap compared to where it's been in the past on valuation bases. I think it's official that the next generation, and you probably do remember the taste of a next generation. I'll give you a second to think about that one. I believe that was Pepsi, no? And basically in the 1980s, 90s, they got into this branding campaign against Coca-Cola, the taste of a new generation, younger people. And that's probably our investment lesson of the day, is that younger people drive revenues. So Dutch Brothers was started with a buy at Wolf Research. There was a downgrade of Starbucks, and it's all tied towards competitive things happening in the space. And Dutch Brothers makes just coffee with tons of protein in it, which America loves. Did you see Demi Moore? One of those clickbait things came across the internet. And she's clearly on Ozempic or one of the weight loss drugs. It's bad. She looks like Nosferatu. She's tiny. And needs more protein. NVIDIA's got a big conference coming up in 7 days. The GTC conference. It's quite influential. That's what we have to look forward to about a week out. I'm just trying to help with the narrative. Let's take a break here. I got to get ready for some TV spot. Then I'll come back and wrap up. Tell you where the markets have gone. I have an event coming up in 2 days, Wednesday, the 11th, 6:30 to 8:30 in Lafayette. You can sign up at robblackshow.com. It's wealth preservation, retirement planning, great time to get some insight from financial planners on your portfolio. And are you ready for retirement? What you're doing right, what you're doing wrong. Lots of content. You can sign up at robblackshow.com. That's robblackshow.com.
These days, retirement planning is more complicated than ever. So set aside Wednesday evening, March 11th, and get ready to learn some strategies for navigating wealth in uncertain times from Stephanie Richman, Rob Black, and Nathan Rogers. This event will focus on retirement income, tax strategies, estate planning, and tax planning. If you're at or near retirement with at least $500K in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves, Social Security strategies, and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. That's Wednesday, March 11th, 6:30 p.m. at the Lafayette Library in Lafayette. Space is limited, so sign up today at robblackshow.com. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
As was the pattern last week, when the market opens down dramatically, there's been a little bit of fight back in the market. The NASDAQ has just turned neutral for the day. The Dow Jones Industrial Average was once down 700 points. It's down 348 points. The S&P 500 is down 1/3%. So it too is, they're all fighting back. Saudi Arabia has cut oil output. The IEA is considering releasing some stocks. So short-term relief might be on the way for oil prices. And again, it depends on how long this strike continues. And if anything worse happens from it at this point, it's being priced fairly quickly. So G7 finance ministers discuss releasing emergency oil stocks, and a final decision could be taken by the 7 countries this week. The G7 includes US, Japan, Germany, France, Britain, Italy, and Canada. The IEA, which coordinates energy policies of Western and some other industrialized nations, holds over 1.2 billion barrels of emergency oil stocks and a further 600 million barrels of industry stocks. Tough times. Let's talk a little bit about why extreme oil price volatility sets off alarm bells for people. RBC equity analysts don't think companies they cover outside of the energy sector will take a big hit from the increase in oil prices. So you're already talking about a large portion of the stock market not being affected. Amongst our non-energy analysts, 72% said that earnings per share impacts from higher oil and gas would be none. So says RBC. Or only little, or not relevant, mixed, don't know. Same was true for 77% of analysts when they were asked about direct revenue in the Middle East impact, and 66% said when asked about the impact from knockdown effects, very little. So when you see numbers like these in surveys of analysts, it suggests the risks are concentrated in certain areas. Obviously, airlines, tourism. History would tell us that extreme moves in oil prices tend to either reflect or cause big changes in demand. People don't want to get stuck. Oil going down a lot tells us that demand is bad. Oil going up a ton tells us that demand will soon be bad because the prices are too high. There's a sweet spot for oil. It's probably somewhere in the $60 to $70 range at this point in time. So when we're near 100, it's problematic for companies that rely on oil, like JetBlue, down 6.5% today, JBLU, United Airlines down 4.3%, Alaska Airlines down 4.75%, Eastman Chemical down 2.8%. Industries who use oil prices are a major input, such as the chemical manufacturers. So Eastman Chemical, one of the biggest ones, ticker symbol EMN. Illinois Tool Works down 1.47%, ticker symbol ITW. Building products like Owens Corning is down 4.2% today, ticker symbol OC. So whether it's the chemical makers, the industrial machinery makers like Illinois Tool Works, or the building products like Owens Corning, it's ominous. Economically speaking, the performance of companies catering to Americans' middle class, who are seeing the jobs number that was quite weak on Friday. And I think that was one of the reasons the market sold off as much as it did on Friday. The performance of companies catering to those middle class, the lower part of the K in the K-shaped economy, Macy's, ticker symbol M, down 4%. Kohl's, down 4.8%, ticker symbol KSS. Best Buy, down 3%, ticker symbol BBY. Texas Roadhouse, down 2.3%, ticker symbol TXRH. I was stuck at a football tournament. Maybe it was a rugby tournament, because it was a tournament. Yeah, it was a rugby tournament. In the middle of Central California. And the only restaurant to eat at was Texas Roadhouse. The only one that looked tasty. They have too many steaks on their menu. So some of the companies, who are worse off, like I said, airlines and cruise lines. But then you do get into things that you don't really think about with Macy's, Kohl's, Best Buy, and Texas Roadhouse, when Americans collectively are spending $150 million more per day on gasoline this week versus last week per day. That takes away from the Macy's, the Best Buys, the Texas Roadhouse. You see where I'm going at with that? The Iran war is igniting U.S. demand for cheaper drone defense systems. The Pentagon doesn't like shooting down a $500 drone with a $4 million missile. I don't know if there's an investment here yet, but look for one maybe if you're trying to profit from war. I got to be careful what I say. From an economic lens, it's pretty straightforward. Iran's Shahed drones, which Tehran has stockpiled in the thousands, cost roughly $30,000 each, and a Patriot missile cost millions of dollars each. Drones can be mass produced. Patriot's interceptor production is limited to 600 units annually. Lockheed Martin is slated to increase that to 2,000 as part of a 7-year agreement with the United States government. OpenAI is going to delay their erotica feature to focus on gains in intelligence. I kid you not. That's a real statement. So let's talk about OpenAI and ChatGPT. They're doing everything PR wrong right now. OpenAI CEO Sam Altman last year had to declare code red to get the chatbot back on track. After the struggles in the last couple of weeks, he's going to have to do it again. Is there a code redder or code crimson or something? OpenAI is moving away from its plan to integrate checkout technology into ChatGPT, instead letting third-party apps do the e-commerce dirty work. The company once believed that integrating shopping and travel booking into its platform could make it a power player. Now it seems to realize it actually doesn't want to get into the customer service business. But it's a stunning reversal, and it tells you what the hell's going on at OpenAI. It's a good lesson on success or failure. Starts at the top. And it's a reminder that they're not publicly traded, but if they were, this would be a mess. Due to OpenAI jumping in and saying to the Pentagon, we'll take that Anthropic government bid, it looked like Sam Altman rushed and hurried to try to get revenue on the books. It inherited a lot of the backlash from what went down between Anthropic and the United States government. U.S. uninstalls of ChatGPT mobile app jumped 295%. ChatGPT's U.S. day-over-day downloads went from being up 14% to down 13%. U.S. downloads of Anthropic's Claude jumped 51%. OpenAI employees didn't like it. The timing looked bad. OpenAI is one of the world's fastest growing companies with a $730 billion pre-money valuation for its IPO that's looking to come out in the fourth quarter of this year. ChatGPT has over 900 million weekly active users. Sundar Pichai is close to achieving billionaire status. He's getting a generous stock compensation, heavily tied towards Waymos. He stands to make way more money thanks to Waymo. For the first time, some of Pichai's compensation will be tied towards Alphabet's autonomous driving project. He could potentially earn up to $260 million just based on how Waymo's value increases over a 3-year period. Additionally, he can earn up to $90 million based on the results of Alphabet's drone delivery unit, Wing, between now and 2029. Alphabet values the robotaxi and drone projects. They see them as assets representing valuable, scalable businesses. Sundar Pichai's annual base salary is about $2 million, and he's going to become a billionaire. Don't you just love America? Or maybe, I don't know. Maybe I'm talking to the wrong crowd here. Microsoft is going to use Anthropic's Claude to power Copilot Cowork, a new agentic offering. The AI world is abuzz with agents that can do your busy work for you, and Anthropic's Claude Cowork is one of the most prominent and capable offerings in the field. Microsoft listed some examples of how Copilot Cowork could help with common tasks such as rescheduling meetings, sending emails, researching companies, working with spreadsheets, and making presentations. China is having a smartphone slump at this point in time. China's smartphone shipments fell 22% year over year in January. According to a new Bernstein research report, the drop was partly due to the timing of the Lunar New Year and tough comparisons with last year. Lower tier phone shipments fell 37%. Higher end sales from companies like Apple and Huawei held up better. Selling prices rose 13+%. Could be good news for Apple if you're looking for things to find good news in. Live Nation Ticketmaster has reached a settlement with the Department of Justice over Ticketmaster. I'm going to do a little research on this one today because that's kind of a good TV story. The company was close to a settlement last week, but they got a deal done today. It spares the Ticketmaster from being broken up in return for making it easier for other promoters to compete in Live Nation venues. The agreement, with negotiations presumably intensifying since the trial kicked off on March 2nd, is expected to get relief to consumers faster than Live Nation going through a trial, so says a Department of Justice official. The settlement would include $200 million in damages to participating states, a tiny fraction of Live Nation's more than $36 billion market cap. Political also expects Live Nation to invest more than 10 amphitheaters and cap Ticketmaster's service fees as its amphitheaters under the agreement. So spin off some locations and cap the fees that you can charge to those locations in the future. The settlement still requires approval of a judge. It's set to be made public today, though. 10 states have agreed to the new framework, according to people familiar with the matter. Always good to be invited to a party. And this party is the S&P 500 inclusion. Data center equipment maker Vertiv Holdings, ticker symbol VRT, Lumentum LITE, and Coherent COHR, as well as EchoStar, ticker symbol SATS, are being included in the S&P indices after Friday. Those guys are coming into the party in the S&P 500. People leaving. Match Group. I once said, and I always thought this was one of my best lines, it's got to be the biggest data repository of sexually transmitted diseases in America. Dun-dun-dun. Shh. Ticker symbol MTCH. Match Group is out. Molina Healthcare down 1 point. Molina Healthcare out, as is Paycom and Lamb Weston. So they're mostly trading lower on that news. BTIG's Jonathan Krinsky commented on the crude blow-off. Overnight, S&P 500 futures briefly tagged the 200-day moving average near 65.84. He views that as a valid test and hold after the break of 6,700. He's obviously very technical oriented. He thinks bulls now need to reclaim the broken trading range of around 6750 on the S&P 500 to confirm another false breakdown. He continues to take a glass half full view. It's obviously a fluid situation. Overnight, the VIX curve inverted by over 9 points, a clear sign of stress, which is a contrarian bullish signal. Energy stocks, he talks about, despite crude trading well over $100 a barrel last night, XLE made its high last Monday. This is suggesting the duration of the crude rally is likely quite short. He's early on his call for airlines to bounce, but he now thinks they appear more fully washed out and into a better area of support. Any downside reversal in crude from here should see airlines with meaningful upside bounce. He's pretty good at what he does. So he's saying look for a bounce in airlines and don't expect oil to hold those highs because it's not. I should talk briefly about Lumentum being added to the S&P 500. That's not the only thing going on for the company. Ticker symbol is LITE. The company has gained significant momentum over the past year as investors are increasingly view Lumentum as a key AI infrastructure supplier, noting that virtually every AI network is powered by its optical technologies, either directly through hyperscaler partnerships or via networking equipment customers. Lumentum has products that are embedded throughout the telecom and cloud data center networks, including transceivers, coherent optics, amplifiers, and switches, while also serving industrial and 3D sensing laser applications. Lumentum identified 3 major growth drivers ahead for the company. Cloud transceivers is number 1. Number 2 is optical circuit switches. And number 3 is the co-packaged optics, not ticker symbol, but CPO. Management is indicating that contributions from OCS and CPO are still in the early stages of ramping. The company recently announced a multi-year strategic agreement with NVIDIA, including a $2 billion investment from NVIDIA to support R&D, to expand manufacturing capacity, and to build a new U.S.-based fabrication facility. Lumentum is quickly emerging as a meaningful beneficiary of the AI infrastructure spending cycle, and last week's developments reinforced that narrative. Adding the name into the S&P 500 is a near-term technical tailwind that helps. The $2 billion in investment from NVIDIA is a good partnership to have if you're going to pick partners. Management's already pulling forward its revenue milestones thanks to strong hyperscaler demand for optical connectivity. Something to think about, okay? That's what I'm here for. Let's take a quick look at the numbers. Last we left off, the markets had fought back, and that is still the story as of now. The S&P 500 is close to break even. The Nasdaq's up 0.25%. The Dow's cut their loss from 700 to 350 to 278. Ed Yardeni has raised his odds of a meltdown in the U.S. on U.S. stocks to 35% from 20%. Airfares are likely to rise. We're paying $150 million more per day for gasoline this week versus last week. The jobs numbers were soft. Job creation under the Trump boom has been weak, only adding 150,000 jobs in his first 14 months of the second term. In the last 14 months of Joe Biden's term, we added 1.75 million jobs. There's some real things to be concerned about. We're going to talk about these at the event March 11th, Wednesday night. That's this week. You can sign up at robblackshow.com. That's robblackshow.com at 6:30 to 8:30. I'll probably get there around 5:30 and chat you up. Sign up at robblackshow.com. It's robblackshow.com. If you're in retirement, heading towards retirement, this is ideal for you. Sign up for the event at robblackshow.com.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.
Joining me now, Nathan Rogers. He will be at the big event in Lafayette, 6:30 to 8:30. Everyone will get there a little bit early if you want to talk before the microphones turn on. It's a good chance to get your questions answered from a financial planning team that is very good at what they do. I think they're better at it than I am. That's why I use a financial planner at AP Wealth. Joining me now is Nathan Rogers. He's a JD, MLS, and CMT. CMT is a chartered market technician. I'm not much of a technician, Nathan. Tell me a little bit about becoming a CMT. I didn't even know it was something you could become.
Yeah, it's sponsored by a group called the Chartered Market Technicians Association based in New York City. They've been around since the 70s. They're pretty much the premier show in town when it comes to a group that emphasizes technical analysis. And they have the CFA, a 3-test process that you go through. The final test of that, which is real world experience process, analyzing charts and making portfolio management decisions in real time. So it's a pretty terrific process that they have. But interestingly, and Rob, I know you tend to be more of a fundamentals guy, right?
Yep, for sure.
The technical side, I think of them as working in congruity with each other. You can use technicals to help validate fundamental stories. You can do it the opposite way as well. Technicals are just meant to give you that extra piece of information that can help you make a better decision, particularly when it comes to exits. That's where I find them invaluable. So it's a different kind of skill set, but for me, it's meant to be used in conjunction with the others.
Good to know. And I'll pick your ear on Wednesday evening for sure. Let's talk about concentrated stock positions or single asset risk. Many in the Bay Area work in the tech industry, create a lot of wealth. They fall in love with the technology. NVIDIA's created many, many millionaires. Apple's created many, many millionaires. Microsoft, many, many millionaires. But you get to the point where you retire and you have this big stock position. You also have capital gains that may be tied into it, or you have I would say, emotional attachment to the stock that got you there. What do we need to know about concentrated stock and what you can bring to the table as a financial planning executive worker?
Gosh, such a perfect question and so applicable, like you said, to where we live, the work that we do here. And really what happens is these concentrated positions in the very names you mentioned, and then a few others, a lot of the Mag 7 type names, they are terrific and have been terrific wealth drivers. But there's an old saying that says, you may produce wealth through a concentration, but you keep wealth through diversification. And there is so much truth to that, because the truth is that we get to a point where we have enough, maybe more than enough. Maybe our priorities change, and instead of seeking additional risk that could be additional returns, we want to start mellowing it out. And for that, we turn to strategies that can help us diversify out of these positions. Or if we're really committed to the positions, they can keep us in the positions, but change our risk profile by using things like options. And these are ideas such as a collar, which is a protective strategy, or exchange fund replication, which is that trade-off of risk where you can turn your position into something that's more like a mix of an NVIDIA and an S&P 500 type holding. So there are different ways that you can do it, which come down to the priority of the individual person, what their preference is, whether they're really committed to diversification or whether they really want to hold the underlying but still get the benefits. And this gets into a conversation about what is going to be the right strategy for you. So for those who want to diversify and see that as a real important imperative, you may use a strategy such as long-short direct indexing, where you can actually, in a very tax-efficient way, start to diversify whatever that core concentrated position is and turn it into something that looks a lot like a very appropriate index. And we have some say-so over this index. It could be the S&P 500 like index. It could be Russell 3000 with a mix of international in there. But whatever that selected benchmark is for what we decide we want your portfolio to look like, we can get you there to diversification. And it takes time, but over this process in a tax efficient way where, let's say you're starting with $10 million of wealth in a concentrated position. If you wanted to sell that, Rob, tell me if I'm wrong here, but you'd be looking in most cases at somewhere close to a 40% total tax bill, even if it's long-term gains.
It's in that neighborhood. Yeah, it's really close, and it's really tough to digest that because, again, emotionally I'm tied to my positions, and I got 3 big ones.
Yeah, and when you're in that position, that's what happens is you get the golden handcuffs, which is the idea that I can't separate from this because although I do see value in reducing my risk, it's going to cost me $4 million or thereabouts in taxes. I'm rounding up slightly, but I think the total add-on gets very, very close to 40%. It's about 37.8%. So I don't want to give up the $4 million, and therefore I choose to stay in the high-risk position. Well, what if there's a way that you could actually, to some extent, have your cake and eat it too, because you could start to peel off this concentrated position and diversify it, but do so in a tax-neutral way where all of the diversification that's taking place is being done in a way where losses are harvested against the realized gains to offset them. And that's the idea of long-short direct indexing, where you can start to do this kind of work. And there's different ways we can go about doing it. I already mentioned there's different benchmarks, but there's also different speeds at which we can do it. And that comes down to how you structure the investment. But these are things that were not available to, certainly to our parents, really not even to our older siblings. These are new solutions that, because of the level of quality of the tools we have today, can be executed with incredible efficiency that enables them to work for a modern high net worth investor that's looking to do these things. And they're not the only strategies. There's other strategies that we have that can help offset even ordinary income through creating ordinary losses that can help with W-2 income. That's usually people's biggest source of taxation, is the tax they pay on their wages. Those are solutions. Rob, you and I have talked about those before, but things like Delphi Plus and other strategies. So there's more than one way to peel back the onion and do it, but it comes down to the clients or the investors' priorities, whether they want to keep the stock, whether they want to diversify the stock, whether it's some combination of those things, and putting the pieces together in a way that works for that particular individual. That's maybe the most important part, is this has to fit for the person. So there's several options. We look through those and we find the fit for the person.
Nathan, you'll appreciate this, that oftentimes I blame my success on being born at the right time. I understood video games as a 10-year-old kid. The arcade, that helped get me into NVIDIA. It helped get me into Microsoft. It helped get me into Apple. I loved gadgets and tech. But oftentimes I also say that I'm successful because interest rates went lower in 2000 and after 9/11, and that helped. But what I feel really beneficial about at this point in time and grateful for is, as I'm approaching retirement, you just talked about long, short direct indexing. The costs have come down aggressively. It is now a strategy that is attractive without the high cost. Am I summing that up correctly when I say that the costs have come down? Because it's an institutional product. It's not something that retail investors can do on their own.
Yeah, absolutely true. And if you think about, and Robin, I know you and I are in the position of having been in this space for many years, these things were not even achievable. Even assuming that there was a firm that had the know-how to do it, the execution would be so expensive that it wouldn't be realistic to accomplish it without building more in cost than what you could get in benefit. And what you describe is how this formula has changed, where now a strategy that either would have been unavailable or unattractive because the costs rise up to being too high relative to the benefits is now much more straightforward for institutional investors who are working with RIAs like EP Wealth to do these things on their own at very reasonable cost relative to the amount of benefit they get out of it. It should be said, there are costs. Those are things that we have to talk about because they're complex solutions. They're not just buying stocks, right? There's a lot more going on in these portfolios, and because of it, there are additional costs. But those are things that we will explain in full detail so that the investor clearly understands before entering a strategy like this what they're looking at. And just like you said, it's shockingly reasonable when you think about the amount of work that goes into producing the outcome. These are high octane portfolios that take a lot of work, but they're there for people that qualify for them. Generally, you have to be at least an accredited investor, sometimes a qualified purchaser. But in either case, for those for whom this is a fit, they're reasonable. Just like you said, they've come down to points that they're very attractive.
Thanks very much. That's Nathan Rogers. You can meet him at a free in-person event to better understand today's market, the volatility, what you're going to do in financial planning as you retire and hang up the W-2 income. You want to create tax efficiencies. You have other issues. We can talk charitable planning. We're going to talk long short. We're going to talk collars. We're going to talk option strategies. All the strategies for creating tax efficiency will be talked about 6:30 to 8:30 in Lafayette, March 11th, Wednesday. Nathan will be there. I'll be there. Stephanie Richman will be there. Show up early. We'll answer all questions. Sign up today at robblackshow.com. That's robblackshow.com.
These days, retirement planning is more complicated than ever. So set aside Wednesday evening, March 11th, and get ready to learn some strategies for navigating wealth in uncertain times from Stephanie Richman, Rob Black, and Nathan Rogers. This event will focus on retirement income, tax strategies, estate planning, and tax planning. If you're at or near retirement with at least $500K in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves, Social Security strategies, and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. That's Wednesday, March 11th, 6:30 p.m. at the Lafayette Library in Lafayette. Space is limited, so sign up today at robblackshow.com. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.